It's all about being creative, guys. All right. So I am going to go ahead and get started. So good morning, everybody. My name is Sean Woolen here at SunWest Mortgage, part of the Woolen Mortgage team. And we are going to start with just an overall review of what mortgage rates are doing, what their trends are to help you guys prepare your buyers for what is to come, especially if it's taken a long time to find properties. So I'm going to go through what I call the candlestick charts as kind of a idea of what's happening with the rates. When the bond markets do poorly, they drop. So I'm going to share my screen real fast and then I'm going to show you what this is going to look like. All right, so this was the last week. These blurbs right here, we actually had a little bit of a run last week, starting March 22nd, 23rd, and then on the 24th, and then we retreated from there. So as you can see, it's been a trend downward in the bond market. So if you can think bonds go down, rates go up, that's kind of the trend. So the overall trend is still lower on the bond market, which means higher rates to come. But we did see, and I don't know if you can see this, but there's this little triangle right here. That's called an alert to lock. When the bond market reaches its peak, that's when rates are the cheapest. So I locked in about 7 or 8 loans right here before the bonds in the next 2 days, they dropped. This actually saved my buyers. Let's see what it is. Right here was the top. So 103.07 to 67, 47 basis points in pricing. So I locked in here. If I would have waited, it would have cost 0.47 discount points to get the same rate if I missed that. So having a lender that understands when to lock is sometimes more important than having the best rates at the time. Because if that person waited or they couldn't get a hold of it or they didn't lock, then they could be succumbed to higher interest rates. So a little bit of overview of what's going to happen in the future. May, we're going to see the inflation numbers be quite higher than what they are now. You guys know wood, the cost of wood is much more expensive. So homes are going to be increasing in pricing just because of the cost of wood. It's amazing how much expensive that is. And with all these issues with the ports, especially the new one, which we have in the Suez Canal, getting the shipments of goods is gonna add some unnecessary, I guess is the best word for it, inflation to the mix. So the next, I think 3 to 4 months, you're going to see inflation poke its ugly head in. That's pretty strong. Remember, that's the enemy of interest rates. So I really feel bad for those people that are in those purchases of new construction where they're not going to be closing till July, August, because interest rates will be higher then. Now, I do believe that a year from now, we're going to enter into a more of a recessionary period. And when I say recessionary period, what I mean is it's not going to be on fire, stimulated by the nitrous of the stimulus package. So right now, a lot of people are getting money, extra money. They're stimulating the economy by spending more. That will die down with the increase in interest rates. That'll add extra pressure to the stock market, and we're going to see things kind of slow down. And I think at that point, we'll see rates start to retreat as well. I think in the low 2s and lower 3s, upper 2s as the final. So expect a year from now to be able to refinance, a year and a half, but for now we're going to probably have higher rates. So don't let people wait to buy because you could always refinance later. I guess that's the biggest point to make. But expect higher rates. Mark my words, there's going to be a pop in inflation May 1st when the numbers come out. So that's a little bit of an update on rates. Any questions on interest rates right now?
So you're saying you think they'll go up again in May, is that right?
I do. I think they're going to hit the high 3s.
Okay.
Yeah, May in the summertime, May, June, July, I think we're going to be in the high 3s. I don't think they'll get into low 4s. They may, but I don't think they'll get that high. I hope they don't get that high, but I think they'll still be great. And I think that's the position that we had before we went into COVID. So it's a healthy position. I think it's normal. But this market is really not normal because we're all running on nitrous right now because of the stimulus package. Once the nitrous wears out, it's going to be a little bit of a hangover, and that's when rates are going to come back down. At least that's the projection of a lot of people. I'm going to show you something real fast, if I can pull this down, just to kind of show you what the overall mortgage averages are. This is the average across the country right now. Daily survey, 3.375 on a 30-year fixed is the average right now on a standard conventional 30-year fixed. So it's higher than it was, but it's still really good. But that's the average. Now, if you have lower credit scores, they could be higher. FHA does have a little bit better rate, just it always has. They don't need that money. So as much as conventional, because it's government backed. It's government owned, government insured, the whole 9 yards. Whereas conventional is privately insured, but government managed. So that was a lot of information real quick, but this is a really good website to go to if you want to know what's going on in the mortgage industry. It's called mortgagenewsdaily.com. Really a good resource for you. Now, the what I want to concentrate on now is the changes that are going to be coming. And this is really going to, in fact, let me see if I can speak properly, impact the first-time home buyer more than anybody. So we already know from my previous meetings that Fannie Mae was going to try to limit the amount of second homes and investment properties that they're financing. They are now going to try to limit the credit worthiness to only take those that are a little bit better credit worthy on the conventional side. So they have announced that their new projections for what they're going to accept is they'll only allow up to 3% of their total portfolio to be over, and it has to be 2 of 3 items, over 90% loan to value, DTIs exceeding 45, and credit scores less than 680. They're going to try to limit the amount of loans that they do in that world. They're going to do it on refis. 3% can have them, but no greater than 6% of the total portfolio can be over 90% loan to value, credit scores less than 680, and debt to income ratios exceeding 45. So I'm gonna pull this in so you can kind of see my notes here, so you can kind of see what I'm talking about here. This is the breakdown right here of what they're doing. So what is going to be the unintended consequences of this? If you have first-time home buyers that are doing it conventional because it's a better loan for getting an acceptance on a contract, that have a 660 credit score, that are doing the home in 5 or any of the DPA, you may have a really tough time qualifying. So basically what they've taken, there's an algorithm that every lender has to use, what's called desktop underwriter or DU, or loan prospector, which is LP. Those are the automated underwriting engines that have built-in algorithms to get loans approved automated through Fannie Mae and Freddie Mac. Every lender in the United States has to get an approval through those in order to do a traditional mortgage. Otherwise, you do what's called a manual underwrite. So that algorithm is what they changed. So what I witnessed last week was we were having a really, really tough time getting those low down payment transactions approved at like a 48% back-end ratio. Even if they were putting a lot of money down, they're getting more strict on those approvals. And it's because of this. So a lot of customers that we may have pre-approved 30, 60, 90 days ago, up to 50% DTI, which was the average max for every conventional loan to get approved, now is going to be pushed down to the 45 limit. So anyone that you have pre-qualified will need to, every lender has to go through all of their pre-qualifications, rerun it just to make sure they have an updated approval. So if you have people that have been shopping for a while that are in the high debt to income range category with low down and maybe lower credit, it's going to be more difficult. And these obviously aren't positive things, but we need to just brace ourselves for it, set proper expectations for it. And the one thing that's important to know about this is if you are talking to a buyer where their expectations have now changed because they were at 350, now they're going to be closer to 310, that hurts. That's painful. But if we do it right up front and have their expectations set on what they can get right now, they don't know any better. They don't know it's changed. So it's only really going to hurt and frustrate those people that are already pre-qualified. Those that are going forward, they're not going to know any different, but it will limit the amount that they can qualify for. So some unintended consequences is the first-time home buyers that want a conventional loan will be limited by how much they can afford, just because of those new rules. And I think FHA loans will have a lot more activity. FHA hasn't mentioned anything about their changes at all. So FHA can go up to a 55 back-end ratio. That may change in the future, but for now it's 55, whereas conventional is 45. And if you have more down or better credit scores, you may be able to go higher than that. But for those that are first-time home buyers, it's going to be more difficult to do a conventional loan now. So a lot of those will move over to the FHA. But guess what? FHA limits are only in the 350 range, whereas conventional is at the 548 range. So that's a $200,000 discrepancy in loan products. So there may be some challenges with the low down payment, larger conventional loans for first-time home buyers that we need to navigate through, especially if they're already pre-qualified in that world. Now, if somebody does have a 660 credit score or 670 credit score, if you go to FICOBoost.com, www.ficoboost.com, it'll take you to my webpage. I own that domain name. I'm going to spruce that up in the future, but for now, it's a free portal where people can go to sign up for free credit boosting. Essentially, I'll run their credit. I'll give them a path to get higher credit scores. That way they can get on track to be ready to do a conventional loan if that is a low down payment option with high debt to income ratios. So it's going to be more important than ever on the conventional side to have higher credit scores. Even if you have a tremendous amount down, a lower credit score in conventional, the 660 may not get you an approval. So it's going to be very important to get higher credit scores. Obviously, those who are previously approved will need to get reapproved using these new algorithms. So if you have people pre-qualified with a different lender, make sure they're rerunning those numbers. And remember, those that fit 2 out of the 3 will have a harder time. And I believe, because this is just how Fannie Mae does it, the only way to keep more people or too many people going into the approval ratings and that between that 3 to 6%, like I told you, is to make the adjustments to rate pretty significant if you fit within that range. So I expect the rates for people with a 680 credit score or lower on a conventional to have a bump higher. I also think that the 10% or less down will have a little bit higher rate as well. So we'll have to navigate those waters to see how the markets react to that. But some solutions to this is to make sure we're using FHA as an alternative. As a listing agent, we need to really re-educate ourselves on why FHA is scary, because it really shouldn't be, other than the appraiser maybe having some safety concerns, health and safety issues, or the property being dilapidated. Those are the only really concerns you should have regarding an FHA loan. If it's approved through underwriting and it's an FHA buyer, it's the same process. So the only issue is typically appraisals, because if it comes in low, it sticks to that property for 90 days, but it's only sticking to that property for an FHA borrower, not a conventional borrower. So if you have an FHA appraisal that comes in low, you can get a conventional buyer and disregard that appraisal. Whereas on FHA, it sticks to the property. Those two things, if those aren't an issue with you, if health and safety aren't a problem, and you're probably not going to get a lot of additional FHA offers, because there may be conventional offers on the table, but your FHA offer may be better and they may have extra money for extra down payment. Don't be afraid of FHA just because it's an FHA loan. Talk to the lender, scrutinize that, because a lot of people will be forced into FHA because of these new rules on conventional. So
I'm sorry, Sam, how long does that FHA stay with the loan?
It's 90 days. It stays with the, is it 90 or 120? I think it's 90 days. It stays
90?
with the property. So if you get an FHA loan and it appraises low, that FHA stays with that case number for that property for that time period. Once that expires, you can then get a new FHA case number with a new appraisal for that property. VA and conventional don't have that rule.
Can I ask you a question? If you went through that and you got a low FHA appraisal, and then someone switched to conventional, does that FHA appraisal affect the conventional? Okay, no. All right. Okay, so only subsequent FHA appraisals. Okay, got it.
That is correct. Now, if that happens with VA, a lot of lenders have internal rules that say the VA will follow, but it doesn't. The only challenge is if you order another VA appraisal, a second VA appraisal with a new VA buyer, you may get the same VA appraiser because there aren't a lot of them scattered in the areas that we need. So that's the only negative on VA. But as far as ways to overcome these challenges, we need to really stay in tune with our buyers, make sure that we're updating their pre-qualifications if they're still actively looking, if they're in this range, because this can have an impact. We were running a couple and we've noticed a couple people that we pre-qualified a month ago. We now have to get, a little bit creative with getting their pre-qualifications updated. So it's going to take a lot of work on everyone's part if we already have people in this arena, but it's something we really need to focus on so that we're not getting blindsided when we make an offer and then try to run it and all of a sudden now it's not working. That will happen. I promise you that will happen. So make sure before you make an offer, every offer that you're making to the buyer, make sure the lender has rerun the automated findings to make sure it works. That's going to be absolutely key to success moving forward for these. And again, it's only in this group where they're putting 10% or less down, their debt to income ratios may be high, and their credit score may be below 680. All Fannie is saying is 2 out of 3 of these will make it more difficult to get a loan if you have 2 or 3 of these highlighted areas that I just put on the screen. So with that being said, I want you guys to know ahead of time so you can have the proper tools to spearhead this and to really get ahead of it, because it can be challenging. It really can. So I'm going to unshare my screen and see if you guys have any questions as we move forward. Can you please email us that document? Oh, that's my little notes that I made, that Word document. I can absolutely do that. When did the new rules for conventional start? The letter came out on Friday, but I think they implemented it before that because I noticed a few loans that we should have gotten approvals on, we were getting refer eligible, meaning it meets guidelines, but it's not accepting it. I saw that last week. So I think they're in place already is basically the point here, which sucks. But again, we just have to roll up our sleeves and make sure everyone's set up for success and their expectations are set properly before they start shopping for homes. Will this mean that blended loans like 80-10-10s will be coming back? Potentially, but when you run an 80-10-10, it knows it's a 90% loan to value loan. It already knows that. So it's already in the system. So you can't really trick it. But we are doing 80-10-10s quite frequently right now, mainly for those scenarios where, let's just say the person's selling a home and they want to put a big down payment down, but they don't want to do it with a contingency. So we'll do like a 60-30. We'll do a 60% first mortgage, a 30% second mortgage with only 10% down. And then when their house sells, we'll pay off that 30% second mortgage and be left with a first at 60%. But yeah, you'll probably see people get more creative as we move forward. And it's just something we have to just be aware of and be very cognizant of it, especially when you're driving people around for weeks on end, making offer after offer. It would be really a travesty to make an offer on a property, get it accepted, and then not be able to qualify because they're stuck in this quandary, so to speak, of these new guidelines. All right, so I'll try not to take too much time on these calls, but any questions that you guys may have? If anyone's telling you they think that real estate market is going to go down, just the cost of lumber, that piece alone will probably keep them rising. And that, guess what? That's inflation, which means rates could rise as well. But I do think we're going to see the market slow down in about a year. But until then, guys, we're going to be having a very difficult time getting these buyers into homes, and we need every trick of the trade. So don't forget about our bid over ask program, which will tell them if they make a $50,000 over asking price, how long it'll be to recoup that in a normal appreciation market. And then really get creative on if somebody has 20% down, may do 10% down and keep that extra money to put towards the difference on the appraisal and the final purchase price. Yeah, lumber up 60%. Yeah, I mean, guys, that's going to make homes be more expensive. So, but you know what? Capitalism will bring out new materials and new interesting things. I just saw this interesting block that was created that has a combination of foam and concrete that was cheaper than lumber right now, that they're going to be start using on properties. So you're going to see alternative methods pop up that are going to be cheaper to keep costs down and to be more competitive. But that just means more changes, right? So change can sometimes be good, sometimes be bad, but as long as you know how to react to it, I think that's what's going to set us apart, guys, moving forward. So just make sure people know long-term rates are going to be increased, but that's okay, because a year and a half from now or a year from now, there may be opportunity to refinance back. I think it will happen, but it's going to be about a year and a half out. All right.
Thanks, John. Great information as always. Really appreciate you.
Yeah, my pleasure, guys. Anything you need at all at any time, just email me, send me a text, and then we'll get back to you. So there are a lot of other alternatives. Here we go. Here's some people. Yeah, I mean, there it is. There's change. House efficiency is going to bring a lot more different products as well. Now that wood's going to be more expensive, it's going to enter in all of those products that are what used to be too expensive. It's going to bring those right back into the market as alternatives. And a lot of times they are better for overall efficiency, so to speak, in property. So if you want to refinance now, I say jump on it, because rates still are in the low threes. But I wouldn't pay any points, because if a year and a half from now they're in the 2.75, at least you saved enough money over that year to recoup the costs. And we have to really look at it to see if it makes sense. But if you're in the higher mid threes, you'll probably be able to refinance about a year and a half. Remember, guys, this is an interesting fact. The average life of a loan is a year and 2 months. It's 14 months. That's the average life of a loan before the property sold, or before the loan is refinanced, or before it's even just paid off. So interesting statistic. So a lot of times people get really afraid of the rate they're getting at the time of their purchase, but it's very short-lived, that average. So it's very interesting. I have people that refinance every 6 months for some reason. They're either lowering their term, they're lowering their rate, they're making a big principal reduction. There's a lot of different things. Pulling cash out to make home improvements. There's a lot of reasons for that. So refinance is always a possibility. It has to be part of the equation if people are not super happy with current interest rates. It has to be part of the that discussion. What indicators do we look at to see possibility of rate decreases 1 to 5 years from now? When you see a stock market pullback, when you see the inflationary fears come back and the jobs numbers start to dwindle, and the overall growth of the economy, the GDP lowering, bad news in the economy is good news for interest rates. So keep that in mind. Bad news in the economy is good news for interest rates. You can always watch the bond market on that Mortgage News Daily. There's a bond ticker on there that'll show you. I'll share my screen so you guys can see this again. Hold on 1 second. This bond ticker right here shows you what the bond markets are doing. MBS Treasury markets, that's the bond market right there. These are the values and the yields of the bonds. So if these are in red, rates are going up. This means we're bleeding. That's a bad thing. If it's green, that means it's a good thing, positive, and rates should be getting better. But you can just watch this, and I would flag this as a favorite because there's some really good information in here, guys. There's stuff you can sell. There's market data in here. There's all these different under construction numbers, housing production. I mean, there's so much stuff in here, guys, that would be really good to share with your customers. Just a tremendous amount of information in here. There's a community, there's comments in here, there's Q&As, there's videos. There's tons of information, guys. There's news streams, what's going on in the news. Refis constitute 3/4 of Freddie Mac's February volume. That's scary for them. But there's lots of really good information in here. So keep this as a favorite in your browser because it's just good data. All right. Any other questions for me? What is that score again?
Oh,
All right, so
yes,
I'm gonna,
this is fine.
I'm going to copy these in here just so you guys can see this real fast into the chat. Hold on 1 second. Got to go back. These are the 3 items that are going to make it more difficult to get an approval. So you can copy that and paste that, but I'll send that little breakdown of my notes for the call. I'll send that out to you guys so you can see that along with a copy of this video. And again, if your customers have questions, it's just good to be informed. And again, setting expectations early will help counteract any issues that may come in the future. So it's good to make sure expectations are set so that people don't get freaked out if rates go up a little bit. Just have it part of the conversation. All right, let's see if there's any other questions. So as bond rates go down, interest rates go up. That is exactly right. That is exactly right. Should people refinance to eliminate PMI? Yes. Because everyone's equity is up right now. Everyone's everywhere. I mean, that one person sold their house for 600,000 when they listed it for 500. So yes, that becomes a new comp. Everyone in the neighborhood just got a massive boost. If they have mortgage insurance, maybe a good email to these people is, hey guys, I want to help you. It's a tough market out there, but check out your value. If you guys are interested, I have a program, I have a HomeBot. I don't know if you guys use it. But if you want your customers to get information on what's going on with the values of their homes, I have a domain name that I have called gethomebotnow.com. They can click on that, sign up for HomeBot. It gives them a value of what's going on with their property every month. It gives them a report card. It's just a neat thing to get. So if you don't know what that is, check it out. It's a neat little program. But yes, tell everyone you know that may have mortgage insurance, any FHA buyer you've had in the last 3, 4, or 5 years, it does make a big difference, a couple $100 a month to refinance in. And here's a little tip for you guys. It's a refinance tip. This is really important. When you refinance a home, do not do a 30-year. Try to match the term with what you have left. As an example, if you guys all had a 27-year mortgage, or you have a 27 years left in your mortgage because you've been in it 3 years, refinance into a 27-year term. Don't restart the marathon by doing a 30-year, because then you're just repaying another 3 years of interest for no reason. Redo that on an equal term or a lower term. It's just a good financial decision. Now the customers will be enticed because the payments are a lot lower on a 30-year term because now their balance is quite a bit lower after 3 years. But that's not a good sound decision. And a lot of lenders will not tell you this. They're order takers. They'll just listen to what you want and they won't explain any benefit. So be careful when refinancing, you're not restarting the marathon. I equate it to like running 5 miles of a marathon and then somebody dangles brand new shoes so that they give them to you to run and then they have to start over at the very beginning of the marathon again. Like, it doesn't make sense. It doesn't make sense. So be safe in refinancing, but yes, it does make a lot of sense to always remove mortgage insurance from the equation through refinancing. Always. All right. I'm going to stay on for a while if you guys have any lingering questions. So if you want to hop off and go about your day, I know it's busy out there, so go ahead and do that. The video will be sent to you as well as a breakdown of my notes. So you can kind of see what we're up against in writing. And you guys are very welcome. Have a wonderful day.